Hey everyone, Bob Kendall here. Just want to thank you all for watching my videos. If you do want to support the channel, go to www.kendallreport.com/wavetech. Sign up for our software. You get market grid on 165 individual stocks and indices. You also will get 16,500 buy and sell signals on our entire database. I thank you so much for supporting the channel. Those of you that already signed up, thank you so much. Welcome everyone to the Kendall Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we get into tonight's video, there was a number of major events that happened yesterday. Of course, we had the inflation numbers coming out. The month over month was a 0.6. It was expected to come in at 0.4. Year over year, 8.4. And the annual rate of the first 5 months of this year is 6.4%. So these are very elevated numbers. The U.S. was in about a 2% range for about 30 years, and that's always been the Fed's target. The Fed has indicated they were willing to tolerate higher rates as we came out of the COVID crisis, and they're likely to continue to do this. I've always been a big Milton Friedman fan. He always talks about how inflation is always monetary related, and I believe that's true. In spite of all the money that they pumped in, it's interesting that the 10-year treasuries are not buying into this. In fact, when the numbers came out, we printed up to 153 on the 10-year, and it fell all the way back and finished at 145. So we're not really seeing any expectations or anybody believing from the Treasury viewpoint that inflation is going to be a problem. I talked about this in the live stream. I mentioned it in the last couple of videos that I do have some new projections that are coming out, possibly in Q4 and Q1 of next year. My expectations are that we'll see more elements come into play as we move forward. One of the things that looks like is becoming a possibility is that the Fed may actually taper a bit, but where would they taper if they were going to do that? My estimation is they should do it in the mortgage-backed area. Let the housing market cool off. There's plenty of demand there. Slightly higher rates would not change things a lot. We could see the Treasury market start to move back higher. As I mentioned also in last night's video, I thought we would be between a 144 extreme downside and the upside would be around 162, 164. So I think we're going to set up this range, and we're just seeing some of the extremes at the moment. I don't think this Treasury market will continue to decline from here, but we'll watch it closely as these numbers come through. As I have been suggesting for a number of weeks, I believe the inflation numbers are going to stay high, and I don't think they're transitory. I believe by the fourth quarter of this year, maybe coming into first quarter next year, we'll be able to actually put a better measure on that. Right now, what we're still operating in is lower taxes. They have not raised the taxes yet. So we're operating in that same monetary environment that we were before. There's a lot of money out there, but taxes are low. We're seeing productivity and employment continue to come on. So that's why we're seeing the markets act favorably to these numbers. I don't expect to see these inflation numbers actually affect the S&P or the market indices. As I've discussed in some live streams in the past several months, is I believe the S&P might be your best inflation hedge. And that's why we didn't see any real reaction here, because we're still operating in the same environment we were in last year. And in fact, going back to 2017, tax laws haven't changed. They're talking about changing them, but they haven't changed. And the markets are going to continue to respond to those type of elements, I believe. The other factor that I've talked a lot about is that the dollar remains reasonably stable. It's staying above some of those key levels I've talked about, around 89.29. We're still in the 90 handle. It looks like that's going to continue to be stable. And as long as we don't see the tax rates change and the dollar start to collapse, because the current monetary environment left alone, the Fed is behind the curve on this inflation if they start to raise taxes and we continue to have all of the money flowing into the markets. So this is going to be the big element, the big thing to watch. I'm setting you up for next week's live stream because I'm going to go into more details on these elements. But I wanted you to have some food for thought over the weekend. As we look back on yesterday's action, we did see the S&P up 0.5%. The NASDAQ was up 0.8 and the Russell was down 0.7. So we saw that spread come back in. I talked a lot about the possibilities of the small cap starting to lead again. We had some pretty good momentum going and that's pulled back. So I think we're back in the neutral phase, and that has everything to do with these inflation numbers. They favor some of the higher growth stocks that are out there right now, and that's why we saw that. Also looking at the action yesterday, our database had basically a rotation. We're still hanging around 62%. I'll go through those details here in a minute. We came close from a technical viewpoint, getting an RTX sell on the S&P cash, but we just missed that. So we continue to be in a fairly positive configuration as we come into the end of the week. Let's take a look at the charts and see how they're set up for Friday. As I reviewed the WaveTech database, as I mentioned in the opening comments, we did see a slight negative rotation. There were 471 new buy signals, 665 sell signals. So we had a slight negative rotation. We remain at 62.22%. I was hoping that we'd see more traction come in with the all-time new close that we saw yesterday on the S&P, but we did not get that type of rotation. We are coming into Friday, so our intermediate models will run. We did see a slight uptick next week. I continue to see a stable environment on the intermediates. We could see a slight increase, but overall we should stay above the 68% to 72% level. We're currently at 71%. Before getting into the indexes tonight, I did want to talk a little bit about the commodity index. This is the Thomson Reuters Core Commodity Index. And this is a weekly chart with the PPMs on it, also with the market grid. We continue to move up sharply in here, but here's the perspective that I want you to understand, is that we have a long ways to go before we really start to see prices overheating. As we go to the monthly graph, what you'll see now is that this index was quite a bit higher just going back to 2011, and we were in really a deflationary phase, which a lot of people talked about over the last several years. But as we come out of this, we're starting to see some serious acceleration in the PPMs. The configuration suggests that we are starting to break above these numbers, and this is probably going to correspond really well with the gold chart. And I always cover gold, and a lot of folks ask, why do I cover gold? It is because of this inflationary expectation. I believe gold is still a good element to look at. This particular index is also suggesting the same thing. And the final thing I want to show you is to go into a really long-term chart here, which this goes back to around 1994. But this is a quarterly chart. You can see here now that the PPMs on a quarterly basis are just exploding, and we're coming up to some resistance area. But the potential for inflation is very big at this time. This is why I do not believe inflation is transitory, that it is going to last for a while. I think the disruption that we saw in all production levels last year, along with supply interruptions and other elements that are out there that are going to affect commodities and a lot of elements, will continue over the next probably 2 to 3 years. I don't think it's going to be that easy that all of a sudden everything normalizes next year in 2022 and all of those type of things. Going forward, I'll be talking more about this index because I think it's important to watch, and I'll break down some of this stuff, and I'll go into more detail when we get into live streams in the next several weeks. As I review the S&P futures, I'm sticking with the June contract. A lot of the front-end contracts have rolled over to September, but I'm going to stick with June for probably another week as we come in toward expiration. But we're at 42.40, up 2.5 overnight. We're seeing this thing continue to move into an all-time new high. We finally have broken out of the market, but we're not seeing extreme acceleration, and this is actually healthy, not negative. This suggests that this trend is very sustainable. Now, we're not seeing acceleration across the board. As we look at the PPMs, We're seeing ppm2 accelerate. ppm1 is remaining at 0.09, ppm2 at 0.20, and ppm3 at a 0.04. So we're not seeing this really robust acceleration. So it's a gradual move. As I look at the market grid for today, we've had a low of 42.34, high of 41. We look at S1 42.30, possibility of an R2 today 42.53. So we could see some decent upside today, and this will also represent an all-time new high, and I'm expecting that we will maintain a reasonably stable market and close into an all-time new high. So we look at the SPX. As I mentioned, we did trade above the RTX number. 42.40 was that number, high 42.49. Yesterday closed at 42.39.18, just below that. We look at the market grid for today. Expectations are for a 42.33, which would be an S1, R2, 42.51. We should continue to see this market move higher in the pattern. The absolute downside at this time now is 42.15, which is the 10-period moving average. As in the futures, we're not seeing any extreme acceleration. The one other mention I want to make is we look at the weekly market grid. We have printed an R1 42.48.91, the high yesterday 42.49, so we've satisfied that. I don't think there's a possibility of getting to an R2 in this configuration. Just reference the numbers. R1 on a monthly basis is 42.57, so we should at least reach that. The next number on the monthly pattern is actually R2, which is at 43.17. I'll cover this depending on how we close today on Sunday night's video. Next market I'll cover is the NASDAQ. We're up 16 handles overnight. Volume continues to be pretty light on all of the futures, but we are in a trend mode on ppm 1 and 2 on the NASDAQ. We did see it trade right up to the RTX number yesterday. We did get up to the we did get up to the 13,966 level. RTX was 13,940, so we printed above it. We closed at 13,950. RTXL signal. We could see a move back towards S1, but my expectation for today, just like in the S&P futures, 13,909. We've had an overnight low of 13,953 with the R2 14,038. We may see this move back above the 14,000 level. The final market I'll cover tonight is gold. Gold continues to hover right around 1900. We're at 1901.30. I've talked about the substantial amount of resistance just above the level. Now we do have a signal of a cycle to come in today. I do expect to see this be a continuation cycle, meaning that we will see higher prices as we come in next week. PPMs are somewhat mixed. PPM 2 and 3 are positive, which suggests we're likely to see an upward slope. I talked about this the other day, that the primary demand line will be the 21-day moving average at 1890.30. That'll be major support. I don't see us getting below that level, and we should continue to move higher. As we come into next week, we're probably going to be looking at printing up around the higher end of this range between 1915 and 1922. I'll go through all these details on Sunday's video. This will complete the video. Thank you again for watching all my videos during the week and participating in the live streams. Have a great weekend. We'll talk to you on Sunday night. Hey folks, if you enjoyed this content, make sure you subscribe, hit that like button and the notification bell so you'll know when I do these videos.